G'day folks, welcome back to another update for the S&P 500 and the NASDAQ. Now we've got new highs still persisting, but do watch that divergence that's still in play. So again, never ignore divergence. If we're going further, make sure you hit that like and subscribe button to support the channel. Also, we did put out a +1 video. For those new to the channel, reference that video, links in the description below. And we're looking at various trading strategies. And today we're covering the CCI14 as well. In terms of the outlook for the fundamentals for both the S&P and the NASDAQ, the S&P earnings remain strong and support modest gains. Valuations are high, so upside is limited unless growth accelerates. Fed rate cut helps, but inflation and geopolitics remain key risks. For the NASDAQ, tech and AI continue to drive growth, but the index is highly rate sensitive. Valuations are stretched, making it more volatile. Greater upside potential than the S&P 500, but also higher risk. So for the S&P, first of all, we look at the long-term trend, and on the weekly here, the price is still rising, but do note we've got a long-term bearish divergence here. Lower highs on the CCI1500 down here versus higher highs on the price, so that's a bearish divergence. Hasn't started to pull back yet, and as soon as it does, we'll draw a Fibonacci retrace on that. On the daily, you can see there we drew that resistance previously at 6,600. It actually paused there for a couple of days, then it finally broke through in the last few days. And that's now a new, I'll move that resistance. That's actually a new resistance up there. So, but also notice as well, we do have a declining CCI highs. It's a bit hard to read that, but that is declining versus higher highs in the same period, higher highs on the price. That's a bearish divergence as well. Again, I'm not going to draw a target range for it, but as soon as it starts pulling back, I'll draw a 38% Fibonacci range. Now, if I zoom out, you'll notice here I did have all these previous longer or larger term pullbacks. Back here to 2008 was the GFC, so the tail end of that. This was the COVID-19 retrace, and that was again because of these bearish divergence. And then we did also see a bullish divergence there, which gave us an opportunity to go long. We had a bearish divergence back here. That was actually that was COVID. Sorry, that was COVID. This one was the 2015-16 drop due to China slowing down an oil price collapse. This is the COVID one here, and this one here was the 22 inflation and Fed tightening, which had a bit of a pullback as well. Again, another bearish divergence, but notice we did have also a bullish divergence, and that would have been an opportunity to then go long again if you're trading in direction of the weekly. We always trade in direction of the higher time frame, and I'll demonstrate that on the back test in a minute. Zooming in at where we are at the moment, like I said, we did have another bearish divergence back here that pulled back, and each of these rectangles I've marked as target areas, and they've all pulled back in those targets. And this one yet hasn't pulled back yet, and as soon as it does that, I'll draw a target range for that. That's the daily. Now on the hourly, even if you're trading on the daily, it's worth looking at the hourly as well, because you want to see any micro moves. So you can see there we've got lower highs on the CCI versus the same period, higher highs in the price. Now we did have a smaller, each of these points you'll notice, to that first high there on the price was higher versus that high there. That was a first indication of a bearish divergence. Now we drew a target range for that and didn't actually hit it until this point here. So what you do in this case, you let it run. That's why I don't trade these, because it's a bit hard to tell exactly where it's going to fall. Now in this case, you can see there it broke below the moving average band. And the reason I've got multiple moving averages, as opposed to just the one, I like to see these bands expand like they did back here. You can see there was a bit of consolidation on the price, very constricted moving averages. Back here was somewhat constricted, but here was beautiful, nice expansion, and that would have been a nice area to go long, or alternatively going short when the expansion is on a downside. So you can see there that consolidated, bounced, went higher, and finally broke to the downside. A bit of a short positioning there, and it finally broke down and hit that target range. The point is also the lower highs on the CCI. Just keep tracing it on both the price and the CCI. As long as those highs are lower there and higher there, you just expand that divergence range. Again, that's the 1 hour time frame. Now looking at the back test, this goes back to the start of May, and that happens to be back here also where I've marked this arrow approximately, and you would have taken long trades during that period, and each of those points you would have closed out your positions every time the CCI broke into that moving average range. So here, for example, you would have let the 1 hour strategy run and closing it out the very latest when that CCI hits that moving average range. So you would have got in somewhere in that one of those top candles there and avoid further declines. Going long again at that point when it breaks higher, and then closing out on the hourly when it touches that moving average range again. So you notice the CCI gives you an earlier warning to get out. Now at the moment it's a bit of a tricky one to follow because you'll notice here the CCI is dropping, small little false breaks to the upside, although you probably can still trade that, and that's what I've got demonstrated here. But what you look for on the hourly, if you're trading on the hourly or the 15-minute, whatever time frame you're trading on the intraday, the main thing we look at here is divergence. Now you'll notice here I've marked, it's a bit hard to read sometimes, but I've marked these bearish divergence. Back here, bearish divergence, and each one of those points the price pulled back. This was another longer term one. Now this one kept rising and it finally pulled back there, and you would have had a Fibonacci range in that range there. And that also shows you where you would have avoided these drawdowns. So again, you can see there if I mark that on the daily, you'll notice the daily over here, that corresponds with this period on the CCI when that CCI broke into that moving average range, and that would have avoided you going into that drawdown. But also especially notice, if I zoom in for a moment, as soon as you see the CCI here and the price break, the moving averages break to the downside, that's when you get out of the trade, and you would have avoided that drawdown. And more recently back here we had another bearish divergence, that smaller range as I said on the hourly, and you would have got out once you see that price dropping off. And that's why I'm saying you can still trade this, but it's very risky because you're seeing the CCI dropping off, and that's giving you a bit of a mixed signal. So it's a bit of a difficult one to track and monitor. You could actually just stay out of the trade and don't trade at all until you see a more consistent rise like you did back here. So for the NASDAQ on the weekly, again, that's expanded, it's gone higher, and I'll stretch that trend line to that high there. And that one there is also broken slightly higher as well on the CCI, but that's still a bearish divergence, lower highs versus higher highs. Now, actually that should be back there. Now you'll notice, so bullish momentum on the weekly, but just be careful of that bearish divergence on the weekly. On the daily, similar to the S&P, that was previously the resistance at 24,135, and we're going to move that to that new high. That's our new resistance. Possible pullback, but again, very early days. I'm not going to mark a target range for it on the divergence yet, and we just extend that trend line to that point versus the same period on the CCI. That's probably to that point there. That's still a bearish divergence versus higher highs in the price. And again, if I zoom out, you'll notice here we had a few other bearish divergence and other areas where the price retraced similar to the S&P. Now on the hourly, again looking for any micro moves. That was a double top almost, so that failed to impact. So that wasn't relevant, and I put a target range there. So again, more than 90% of the time it hits these divergence, and a few times it fails. So in this case it failed on that one. Now since then we've got another divergence. This is the hourly again. We've got declining highs on the CCI, same period from there, higher highs on the price. Now I'll demonstrate here how you draw a target. So ideally you want to take it back to the significant high. So any one of these bottoms could be a potential bottom, but I would probably take it back to that point there and draw a target range at 23.38%. So that's assuming it keeps falling. It looks like the CCI is still in a bearish momentum. The price is broken below the moving averages, so that could possibly be on its way down. Now looking at the back test likewise, this is the CCI14 strategy. Again, reference that video I mentioned in the links below. So again, going long when the CCI on a daily is in an upswing, and so is the price, and you can trade and you close out the trades on whenever you see a bearish divergence, in this case if you're going long. So again, I've marked the divergence on the hourly, on the CCI and the price in each of these points, and you can see there most of these could have been played out, and they all did quite well, and very few, again, avoiding the long trades when you see the bearish divergence, or at the very latest close out the trades when the daily CCI touches the moving averages. If you enjoy the content, subscribe at least on a free trial to my Patreon page where I publish weekly bullish shares across regions of the world's markets. Hit that like and subscribe button. Thanks for watching, and see you in our next video.